snagged this off Twitter this morning. I thought it was a pretty good one. So can you elaborate on asset allocations during regime and quad shifts or phase transitions? So a couple different kind of questions there. So I'll pause, let you guys, I don't know if you can expand on that at all there, Daniel, but yeah, perfect. So 4T Capital, thanks again for that, for this question. Perfect. So hopefully you can kind of like get in, the question here, use VIX volatility as the example. So I'll walk through, first the various buckets of volatility. So just as a reminder for anybody that's new or just wants to kind of reiterate these, I'd write these down. VIX less than 19 equals the investable bucket. VIX between 19 and 20, that's the chop bucket. That's what we're currently in. VIX greater than 29 is the F bucket. So I think so that's kind of the buckets of volatility for the VIX. The second thing to consider here is max position sizes within these buckets. So as you move between these buckets, one should probably consider adjusting that max sizing, and in this case, within U.S. equity ETF exposure or U.S. equities in general. For instance, in the chop bucket, maybe you've got a max size of about 4.5%, right? In terms of an equity ETF. And in the F bucket, that drops down to, 3%, maybe all the way down to 0, right? In terms of like no exposure to equities whatsoever as we get really, into the F bucket, right? So I think, again, this is where you got to set your rules, go through your process to understand kind of like as things pivot, right? And where we are, how do you adjust your sizing and and that kind of thing. I think this whole concept, right, in terms of like the buckets of volatility and the adjusting your position size, it applies across all, any asset class, and especially as the volatility of that asset class shifts. If you go back to the November 29th, macro show, Keith mentioned GVZ squarely in the investable bucket within a risk range of 15 to 19. However, if you subscribe to the Macro Pro and the re-rank, you'll see that gold, or GLD in particular, has moved from a number 2 position on November 22nd to the 9th position yesterday, right? So, having that confidence, right, to gross things up at the low end of the risk range in a bullish trends and sell some at the top end of the risk range, that's how you can kind of really, mitigate or navigate some of these phase transitions, and kind of getting better at the execution piece. I think, as I said, as you kind of pivot and move things along, right? And you move from, say, again, the F bucket down to the chop bucket, if you take the opposite in terms of what did actually transpire, right? We moved from kind of 32, 33 on the VIX down into the high 20s and then the mid 20s and now kind of the low 20s. So as we move through that progression, again, if you just kind of look at the re-rank, but really if you just have done kind of some due diligence across the board and dove into past macro shows or what have you, it's increasing your equity, your equity exposure as volatility starts to come down, right? So especially in the VIX in this case. So that's really kind of, what you would have seen in the re-rank is you would have seen, more U.S. equity exposure get added to the list inside of his long only account. We actually, we saw that on ETF Pro as well. This week alone, he added both BUL as well as TAN, right, and silver, right? But BUL and TAN would be U.S. equity exposures. So again, you're seeing that even as of this Monday, Keith adding to that, to that exposure, and as we're kind of in this chop bucket. So hopefully that helps. Again, it's we can get deeper into that question. That is a bit of a deep question, but just kind of wanted to hit the high level there on this morning.